Hello everyone, Andrew here from Forex Trading Academy. In this video we're going to talk about entry types, specifically risk entry, confirmation entry and double confirmation entry, and when you can use them in order to fit them in your trading plan depending on your risk management and trade management rules. First of all, let's talk about the risk entry, which is the first one that I'm gonna show you in the first picture right here. So we have a basic downtrend. As you can see, price came, had a huge drop, it made a change of character right here, created a valid supply zone where price returned to mitigate and retest this POI right here. Most smart money traders, they usually just take entries when price reaches the supply or demand zone and the POI without actually waiting for confirmation, and this is called a risk entry. It's called a risk entry because you're not waiting for any confirmation, you just enter based on the valid POI using a stop loss that can cover the supply demand or POI zone. This type of entries have a low success rate just because, again, there are no confirmations and you can't just enter based on an order block, potential candle or supply or demand zone. A risky entry is best used when you are using the higher time frames to trade. So let's say for example the 1 hour or the 4 hour, and you have a huge 4 hour zone. Just like here, let's imagine this is the 4 hour time frame and you set a sell limit at the 50% of the 4 hour POI covering the high. If you're trading like this, again, you must swing trade. So if you're taking the sell here with the sell limit with the stop loss here, you need to target the low as a take profit. So that's probably a 1 to 3 or a 1 to 4 trade that can take several days or weeks to complete. The way I teach here on the channel, I don't usually swing trade. I don't like taking entries on the 4 hour. I don't like taking entries using a larger stop loss just because in the past few months the market has been a little volatile and it's hard to actually swing trade because an economic event can come out and then you can get stopped out, or your trade can go 2 hours in profit and then immediately with the spike get tagged at break even or even a stop loss. And it's the best to just go in and out the market using the lower time frame so you can secure your profits and then move on to the next trade. Here on the right we have the lower time frame execution. So price is fractal and lower time frames will switch trend first. So that is why it's important, if we are trading for the 4 hour, you can use the smaller time frames in order to have a better risk reward and a confirmed entry. What a confirmed entry means is that you wait for price to reach the higher time frame zone, which is here. Instead of taking a risk entry, you're gonna wait for confirmation. So let's say this is the 5-minute time frame. What you wanna see is price reacting to the zone. So here price came into the zone. The first confirmation that you want to see and that I teach is the change of character from this zone. So here you have the first change of character. This means that you have a good reaction from the zone. Price starts to switch order flow on the lower time frames, which means the higher time frames are gonna follow. So if this is the 5-minute time frame, then usually the 50-minute time frame follows, the 1 hour and then the 4 hour to complete the swing trade. This way we can have a better risk reward. The first entry is a confirmation entry. Now, there's certain times where you want to see this pattern forming, usually when there's a session in place. So when there's London session or New York session, as these two are the most volatile. So for me, for my trading plan, if this setup happens outside my trading hours, I don't take it. I'm just gonna wait for more confirmation for the double confirmation entry or just wait for the next day. Because what price does usually, if this happens outside of trading sessions, usually the next session comes back in to retest and then there's the real move. So the confirmation entry usually means after the change of character, you form a valid, in this case, supply zone with a valid POI, and when price comes back in, you can take the entry here, covering the high here and targeting whatever risk reward there is in your plan. Either a 1 to 5 or you can potentially target a higher time frame structure in order to have a big swing trade using a smaller stop loss. If you don't want to take the confirmation entry or you miss it, then you're gonna wait for the double confirmation entry. What that means is usually you wait for the next break of structure, because when there's a break of structure in the market, in the structure, price forms a new supply or demand zone with a new POI where price returns and then gives another entry. So after the confirmation entry, you have another break of structure here, and then price creates another valid supply zone with a POI inside where price returns, gives you the double confirmation entry, which is usually way safer, and you can enter here either covering the confirmation entry high or just the normal high, and then again take your profit based on your trading plan, either at the low or you just target for a 1 to 5, 1 to 10 or the higher time frame structure. It doesn't really matter. For me, when there's a session in place, so if it's London session or New York session, I usually just go for the confirmation entry and then get another entry at the double confirmation entry if I see more confirmation that the trade is gonna play out. Usually I use a 0.25% risk on the confirmation entry because it's still riskier for me, and at the double confirmation entry, when I'm like 90% sure the trade is gonna play out, then I add additional risk into the trade and then just let it play out. Here's another example where you use liquidity in order to take the trade. So in this example right here, where price comes into the higher time frame and gives a change of character, price usually can do this. So it can not come back to the supply zone, and instead it just gives another break of structure right here and then comes back into the zone, creating equal highs, and then gives another break of structure. So now what price usually does, it can start going up again, targeting the liquidity here in order to take it out, induce the liquidity, come into the first risk entry POI, and then start dropping. When I see something like this, I usually just go for the risk entry because we have liquidity that was taken out. There has been 1 and 2 breaks of structure. Price has formed liquidity, equal highs. So now if price comes back to take the liquidity into the first POI, then for me it's a good trade to take because the risk reward is really good, and you usually have an instant reaction from this area, and you can set break even really quickly in case price wants to start breaking higher. So again, if you want to see more about liquidity, you can go check out the video dedicated to liquidity where I explain how inducement works and everything like that. But usually, again, when you see a setup like this, it's best to take the risk entry because you're going to have an immediate reaction and you can miss out on the trade. But there's also certain times where price can come into the zone, create another change of character right here, and then price give a confirmation entry, and this is one of the safest trade models that you can have in the markets. So if you see something like this, then just execute the trade because you're gonna have a higher chance of it to be profitable, especially if it's during a session like London or New York. We have 2 more examples here, risk entry and confirmation entry. Again, for risk entry, usually what I do is just set a sell limit or just wait for price to spike up because it usually gives a spike up into the zone. So when you see the candle forming really aggressively into your POI, just execute a sell because you're gonna have a really good execution on the trade. The broker is gonna put you in a good price and you can have an instant reaction to the downside, and price can pull away from your entry so you can set break even really fast. Or you can just set a sell limit at the beginning or the 50% of the POI, cover the high. If you don't have time to check the charts, just do that and you're gonna have a good trade. At the confirmation entry, usually I go down on the 1 minute or even a 5 seconds in order to have that tight stop loss when I'm just actively on the charts and I can watch it. I can watch the 5 second, then I usually just use the 5 second to take these confirmation entries, wait for the last confirmation and then execute the trade with a small stop loss, 2-3 pips max on Euro USD, so I can have a really good risk reward and I can go in and out on the trade really fast. So here price builds up liquidity, comes into the higher time frame zone, you just wait for the change of character, you have the change of character here, you have the retest in the POI, you execute the trade. Again, if this is the 1 minute or the 5 minute, you can go down on the time frame. So if this is the 5 minute, you can go down on the 1 minute or even the 5 second in order for more confirmation. So usually I watch the 1 minute, and when price comes back into this zone, I just watch for the 5 second for more confirmation. So like a change of character and the break of structure, and I execute based on the ranges formed so I can have a really tight stop loss. And when price usually just gives a nice reaction, I'm already running at the 1 to 3, 1 to 5, and then I can pull out profits. And if price decides to come back, then I just made my money and I'm out of the markets for the day. Here's a model of a higher time frame order flow with lower time frame execution. So the higher time frame order flow here is bearish. You can see the structural points. You have the lower high, the lower low, lower high, lower low being formed, and then price creates liquidity here. It fails to create a new lower low. What it does instead, creates a new high right here and then creates a higher low right here. So this is where you have the higher time frame change of character, and you can start waiting the lower time frames in order to have a better execution. So what you do after the 4-hour change of character, you mark the demand zone, in this case with a POI, and then you wait for the lower time frames to come in. So you can either wait for the 50-minute or the 5-minute. Usually if it's during a session, again London or New York, you can wait for 5-minute confirmation with 1-minute confirmation for the confirmation entry. Or if it's outside the sessions, I usually wait for the 50-minute, 5-minute and 1-minute in order to take the entry. But let's say we are during the session, so this is the 5-minute time frame. First entry after the change of character, again, is a more risky entry because you don't know if this was a fake change of character and price will realign bearish. So you can wait for additional confirmation. So price comes into the zone, you wait, and then you see the change of character right here. You create the valid demand zone right here with a POI, and in this area, if this is the 5-minute, again you can wait for another 1-minute alignment. So when price comes back into this zone, you can wait for the 1-minute charge here and then execute the trade here. And this is again where your trading plan comes into play, because for me in this area, again, after I have the 1-minute confirmation, I usually look for the 5-second confirmation when price comes back into the 1-minute demand zone. I wait for the 5 seconds so I can be 99% sure the trade is gonna play out and I can have a tight stop loss. Again, this is not for everyone, you just need to adapt it to your trading plan and your trading rules. So for me, that's what I do, it works for me, and I'm gonna continue doing it. Usually, if you just wait, if this is the 5-minute time frame and you just wait for the 1-minute confirmation here, you can have a good trade using the higher time frame order flow and the lower time frame execution. If you miss the first one and you wait for the next break of structure on the 4-hour, just wait for price to return to the newly created demand zone with a POI inside and then wait for the same order. So if this is the 4-hour, if it's during the session, wait for the 5-minute. If it's outside the session, just use the 15-minute in order to take entries with a 5-minute confirmation. But again, just backtest this model right here. You're gonna see it a lot on the charts, especially lower time frame execution is really important to understand. And also don't forget to just trade during the sessions, because that's when the volatility comes in and that's when price has a big move. If you understand that during a day there's only 2 big moves that happen, one during London and one during New York, you're gonna simplify trading by a lot and you're gonna stop looking for counter trend trades and just having fear of missing out when you see a big move. Just know that there are 2 big moves that happen every single day and just focus on those 2 and you're gonna become profitable. Saying that, again, thanks for watching. If you enjoyed the videos, don't forget to leave a like, comment and subscribe to the channel. Join the free Telegram group and I'll see you guys in the next video.